Welcome back to our weekly update. I'm Charlotte McLeod with the Investing News Network, and this is your quick look at the stories we've been covering that you need to hear about. The gold price stayed securely below the $1,800 per ounce mark this week, trading in a range of about $1,770 to $1,795. The yellow metal dropped below $1,800 after last week's U.S. Federal Reserve meeting, where, among other things, the central bank signaled that there could be 2 rate hikes in 2023. I heard this week from Gareth Soloway of InTheMoneyStocks.com, who said he sees gold's price decline as a buying opportunity. He's picked up gold-related assets such as GLD, GDX, and mining company Newmont.
And I'm positioning for higher gold prices down the line. I look at this dip as a buying opportunity. I think it was kind of a flush out of the weaker hands for gold. And I still look at the fundamental story that is, the printing of money continues. With the debt in the U.S., it's not going to go away. They're going to continue to have to devalue the dollar to pay for the debt. And therefore, the long term of gold is very, very bullish.
Gareth has a price target of $2,100 for gold by the end of 2021, and in the next 2 to 3 years he believes it could reach $2,860 based on historical price activity. I also spoke this week about another aspect of the gold market with Stuart Englert, author of books including Rigged, exposing the largest financial fraud in history. Stuart took the time to explain some of the basics of Basel III, a set of banking standards introduced after the 2008 financial crisis. He said there are various rule changes coming up, including one for European banks on June 28th, and these could affect the gold market. The topic is complex, and Stuart noted that market watchers are split on what they think Basel III could mean for the gold price. Some expect a much higher price based on the idea that the rules, if followed, could end manipulation and increase physical demand. Others are not so sure. With Basel III in mind, we asked our Twitter followers this week if they think it will have a positive, neutral, or negative impact on the price of the yellow metal. The poll was ongoing at the time of this recording, but most respondents expect a negative impact. We'll be asking another question on Twitter next week, so make sure to follow us and share your thoughts. We're going to wrap up with battery metals again this week, where INN continues to look into what North America is doing to improve its position in the electric vehicle race. Looking specifically at EV megafactories, it's interesting to note that although the US is home to Elon Musk's Tesla, North America is lagging behind China and Europe. Benchmark Mineral Intelligence is currently tracking 211 lithium-ion battery megafactories, but only 12 are in the US, while 156 are in China and 22 are in Europe. Efforts from the Biden administration are expected to be key in propelling the US forward. The government has proposed an investment of $174 billion in EVs and is calling for more megafactories to be built. However, research firm Roskill is still only expecting the U.S. to have 16 megafactories by 2030. That's all for this week. If you like this video, make sure you subscribe to our channel and turn on notifications so you don't miss future updates and interviews. You can also follow us on social media or click below for our free report or any article mentioned in this video. See you next time.